I do think that's not impossible to get a straight-up shot to $10,000 gold. As I said, there's a strong argument that the US government should revalue its gold at a higher level. And to make that plausible, they need to be buyer of the last resort of gold at the new level. And the higher they can put the number, the more they can reduce their debt. I can explain that perhaps. I don't want to be long-winded for I've explained it several times in other videos, but the gist of it is a sale and repurchase with the Federal Reserve results in them issuing the Federal Reserve with what's called gold notes, which are perpetual, not interest-bearing, and not encashable by the Federal Reserve. So basically, that's effectively a reduction of the debt. But they basically buy back the gold they just sold to the Fed for real money. They buy it back with these gold notes. So the net result is the debt goes down and the government keeps its gold. And it makes, to reduce the debt to the maximum, maybe by a few trillion, they probably have to revalue gold at $10,000 or maybe $15,000.
Gold and silver are moving into a very different environment, where debt, inflation, and central bank policy are all starting to point in the same direction. Clive Thompson, known for his calm analysis of precious metals and monetary risk, explains that this is not just another short-term rally. It is a deeper shift in how investors and governments are beginning to view gold. He argues that the U.S. could eventually revalue its gold holdings much higher to reduce pressure on its debt burden. In that scenario, gold could move sharply, potentially toward $10,000 or even $15,000, especially if the government became a buyer of last resort at a new official level. At the same time, real interest rates are moving toward zero, and if inflation keeps rising faster than interest rates, negative real rates could return. That is historically powerful for gold. Now we present the clips from Clive Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
It is and it isn't. If real rates rise, it would be potentially bad for gold. But actually, that's not what's happening. Real rates are diminishing. Now, a real rate is the interest rate you can obtain minus the inflation rate. And what we're seeing, according to the official numbers, which we know are made up, we can see that the official inflation rate is now rising very, very sharply around the world, not just in the USA. So the official rate of inflation is going up sharply, and the producer price index, which is something which tells us what's coming down the line, that's probably in about 2 or 3 months we get what's happening to the PPI coming into the CPI, is telling us that acceleration in consumer prices is likely to continue. So when the consumer prices are rising, interest rates are not rising as much. You have your real rate going closer to zero. And recently, if we look at the T-bill rate and compare it with the inflation rate, they're now sitting neck and neck at 3.7% or something like that. So we're basically at zero real interest rates. They've gone down. Zero real interest rates is potentially good for gold, but what historically has been very good for gold is negative real rates. So if we see, as seems likely, a higher inflation rate, and even if we see higher interest rates, but not rising as much as the inflation rate, that means that the real rate will have gone negative. In other words, after allowing for the interest you earn, you're actually buying less with your money, so you're going backwards. People then say, why have I got my money in the bank? And they'll do what they basically did back in the 1970s. They're going to move their money into something which can keep pace with inflation. And I think it's not just, the story's not about inflation anymore. It's much bigger than that. But I'm going to use that for simplicity for the moment, which is basically gold. And just going back to something that Michael Oliver was talking about, the 60-40 portfolio and the 60-20-20 portfolio, I put that to the test over literally every period I could find. And I can tell you factually, if you replace 20% bonds in your portfolio over literally any period and measure the return, you end up with a better compound annual growth rate with 20% gold. You end up with a better Sharpe ratio over every period, and you end up with a lower drawdown. A drawdown is the maximum decline in the portfolio over a 1-year period. So on every metric, replacing 20% bonds with 20% gold will give you not only the better, has given, not only a better return, it's given you a better Sharpe ratio. Sharpe ratio is what portfolio managers use to measure the risk-adjusted return. So you've got better return, better adjusted Sharpe ratio, and in the bad years, you've got a smaller drawdown, a smaller decline, absolute, than if you had just the traditional 60-40. I've got that test. I've done it. Anyone can go to my website where I've got a tool where you can do it yourself. clivethompson.com. There's a tool. It's called Portfolio Simulator. So it's free of charge, no email or anything like that required. So it's easy to prove that if you add a bit of gold to your portfolio, you improve your risk-adjusted return. Well, I do think that's not impossible to get a straight-up shot to $10,000 gold. It'd be, as I said, there's a strong argument that the US government should revalue its gold at a higher level. And to make that plausible, they need to be buyer of the last resort of gold at the new level. And the higher they can put the number, the more they can reduce their debt. I can explain that perhaps. I don't want to be long-winded for your. I've explained it several times in other videos, but the gist of it is a sale and repurchase with the Federal Reserve results in them issuing the Federal Reserve with what's called gold notes, which are perpetual, not interest-bearing, and not encashable by the Federal Reserve. So basically, that's effectively a reduction of the debt. But they basically buy back the gold they just sold to the Fed for real money. They buy it back with these gold notes. So the net result is the debt goes down and the government keeps its gold. And it makes, to reduce the debt to the maximum, maybe by a few trillion, they probably have to revalue gold at $10,000 or maybe $15,000. So when that happens, the gold could go parabolic in a single day. And I think it's the argument that why it should happen, why they should do it, is very, very strong. So I think it's a plausible case that we could go parabolic in gold. On silver, the same thing can happen for all kinds of reasons, and it doesn't have to be related to gold, although, of course, I do see the two of them moving in tandem. First of all, silver, there is a lot of silver out there above ground, which is waiting for its price, and that price is constantly moving around. But if I get a feeling from all the people I'm talking to, a lot of people have got a price target in their head of $85 to $100 as their sell price, which at first sight would mean that it might be capped until those people are cleared out. I think those who sell all their silver at those levels are going to live to regret the day. I think that will happen.
Yes.
So what I would be doing, if you feel strongly that you should be selling it, if we have a rally, or you feel strongly you should take advantage of it before it vanishes, just like it did the last time, is what people are going to be thinking, I would say sell a little bit and see how you feel. Because if you sell a little bit, at least you've got something, but you're not going to regret it the next day when the silver's another $5 or $10 higher.
Silver may also have a much bigger move ahead, even if the path is volatile. Many investors may think about selling silver at $80, $85, or $100, but the warning here is simple. Selling too early could be a major regret if the market keeps moving higher. The better approach is patience and balance. If someone feels pressure to take profits, selling a small portion may make sense, but giving up the whole position too early could be dangerous. Silver often moves quickly once momentum arrives, and a $5 or $10 move higher can happen faster than people expect. Central banks are also changing the global picture by continuing to accumulate gold, especially in countries less aligned with the United States. This shows a clear move away from relying only on treasuries and toward holding real monetary assets. Let's get back to the interview.
The direction of travel around the world has been central banks have been net buyers of gold, and it seems that they've been preferring for their gold to increase as a percentage of their assets at a faster rate than treasuries. So there's been a general trend towards gold. Now, this is not so much from the strong allies of the United States. It's more coming from those countries which are less aligned with the United States. And they, I think they're sort of saying, do I really want to have all my financial exposure exposed to one country? And China in particular, we've seen the amount increase. One of the reasons it's been increasing is not only the actual buying, but of course the increase in price. So despite the increase in price of gold, they have continued their buying, adding number of ounces to their reserves. So we've got this double whammy of higher price and number of ounces, and that has led to gold literally becoming a much more important asset around the world in central banks. We do know that Turkey, I hadn't heard about India dumping gold, but we do know that Turkey was selling gold earlier this year in order to support its currency, because the currency was plunging due to their very high inflation rate, which I think I heard the inflation rate was 35%, but hearsay it's much higher than that. And so the currency was going down, pretty much what was happening to Great Britain back in the 1980s when Gordon Brown was in charge of the country and decided to sell off Britain's gold to try and support the currency. Unfortunately for him, it turned out to be what everyone's now calling the brown bottom after Gordon Brown, because he actually sold it at the gold at the lowest price that he could possibly have got. I think it was something like $200 or $300 an ounce he got. And had he not done that, Britain would be a lot richer today. So we've had Turkey selling its gold. I think it's going to be the equivalent of the brown bottom. They've sold it at probably, $4,500, $4,600.
Right.
And they haven't sold all their gold, but they've sold some of it. And will it work to support the currency? I doubt it. I do hear a lot that gold and silver, if you like, are in a bubble. Of course, the prices have gone up, but I think there's two things to say. Just because a price is higher than it used to be does not mean it's a bubble. If we look at the reality of the situation, gold is extremely under-owned. A bubble exists when everybody owns it. So go to any, look around the world, look at the portfolios of the portfolio managers around the world. How much gold do they own, literally, in discretionary portfolios? It's very, very little across the board, probably less than 1%. It's not a bubble. The price is high, but at the moment, gold and silver and precious metals in portfolios are very under-owned. And I think that situation is going to right itself by over time. We don't know when it happens or how it happens, but I think gradually, and then all at once, as Michael said, gradually and then all at once, we suddenly see we're at a new level, and that might come if we go to a revaluation situation in the United States. There are strong arguments as to why the U.S. Treasury should do a sale and repurchase of its gold with the Federal Reserve, because that would literally create a huge amount of money which can be used to, in the short run, reduce the debt. They'd keep their gold. I can explain how that works, but in practice they've done it before, and it's something which they could do again. But if they're going to do it, they need to do it at a much higher price than today's price. I think it's essential that it does happen. The level of US debt is getting out of hand, and the main problem here is the interest rate burden. As we have maturing debt, a lot of the debt was taken out over the last 10, 15 years when interest rates were, as makes no difference, zero. Now, that doesn't mean to say it was zero on 10 or 15-year bonds. It was perhaps 1 or 1.5%. But those bonds are reaching maturity. They're having to be rolled over at today's rate, which is considerably higher. Let's call it 4.5% for simplicity. And the interest rate burden in the United States is rising very rapidly. And it's not just me saying it. You could go to the Congressional Budget Office and look at their 10-year forecasts or their long-term forecasts, and you will see that the interest burden as a percentage of GDP is rising rapidly and is forecast to rise very rapidly in the future. So that basically is going to be unsustainable at some point. I mean, it's already unsustainable, but I mean, when I say it's a question of how quickly the SIH something hits the fan. I see three strong reasons why they're outperforming, and I think the market is recognizing it. The first one I'm going to say is credit card debt. We have an ever-increasing amount of credit card debt in the world, and we know that many people are not going to be able to repay ever. We then have the private credit market, which we know is now blowing up, and many banks and financial institutions have lent into the private credit market, and that's blowing up. But the more important thing, the most important thing, I think, which is affecting us is property, commercial people who bought property as a commercial investment. So step back 5 or 10 years or 15 years, people would buy property with a fixed term loan, typically 5 years. So the fixed term, fixed rate, those loans were typically at 1% plus, let's say, 2 or 3% margin. So they were at 3 or maybe even 4% or maybe 5%, doesn't matter. Right now, the interest rate is now, we're talking about 4 plus 3, 4 or 5. So we're now talking 7 or 8 or 9% interest rates.
Yes.
What's happened, even though the rents have risen by 30% in the last 5 or 6 years, rents have gone up by 30%. What's happened is the cost of finance has risen by more than 100%. So those loans, which are at a fixed rate, are starting to come to maturity now. And as they mature, the owner is having to refinance them at a higher rate, but it doesn't matter whether he can or he can't. The reality is, if he were to sell the property now, the next owner wants the same kind of return plus the difference in interest rate that he was getting back then. So if he was getting with a leverage, let's say 9% return 5 years ago, the new owner is going to be wanting 14% return. That means the property price is lower. And if the property price is lower, the bank's going to say to the owner, we're not going to lend you as much, or you've got to sell it. And if he sells it, he's going to get a lower price, and he may not be able to repay the loan. Nobody should rush into things like that. Now, obviously, she's got credit card debt, which is probably at a very high interest rate.
Yes.
And the mortgage is probably a lot lower. But there's nothing wrong with wanting to own some assets as well as having debt. But what she shouldn't do is rush in and put everything she can lay her hands on into gold and silver, because then she's getting into a very dangerous situation, and she might regret what she did the next day. I always advise do things gradually. So she should buy a little bit, see how she feels. And if she can't afford gold, then obviously silver is the poor man's gold. So obviously gold, it's a chunky piece. Now you're talking about $5,000 to buy a gold coin roughly. And that's a chunky bit of change for a lot of people. But there's on the other hand, there's plenty of people who are quite happy to buy 100 ounces or 1,000 ounces of gold in one go. It depends on how much you've got. But she clearly does not if she's got all this debt.
The bigger message is that gold and silver are still underound, not overound. A bubble happens when almost everyone already owns the asset, but most portfolios still have very little exposure to precious metals. That means the real reallocation may still be ahead. The traditional 60-40 portfolio is also being challenged. Replacing a portion of the bond allocation with gold can improve returns, reduce drawdowns, and deliver better risk-adjusted performance. This is why more investors may gradually move toward a 60-20-20 style, with gold playing a larger role. The debt problem is becoming more serious as old low-rate debt rolls over into much higher rates. That raises the interest burden and increases pressure on the financial system. Credit card debt, private credit, and commercial property refinancing are also major stress points. So the case for precious metals is not based only on inflation. It is based on debt, real rates, central bank demand, and portfolio protection. If this shift accelerates, gold and silver could move gradually at first, then suddenly. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.